Okay, this clip is from Adam Parker and Trivariate Research, and this is critically important to what we're going to talk about here in this video, following news that Mike Wilson and Morgan Stanley just turned bullish, but like ultra bullish.
I wrote that on Sunday.
Yeah.
Is it going to be a sell the inauguration? I had this dinner Tuesday night. During the appetizer, I was like, maybe it's January 1st. And then during dessert, I was like, maybe it's the Monday after Thanksgiving. I was like, because as I heard, like everybody,
heard from
everyone was so bullish. I was like, whoa,
right.
You know what I mean? Because, I think we all remember that first couple trading days of 23. People forget now, but Nvidia and Meta were awful stocks in 22. They were down 50, 60%.
Yeah.
And the correct move, if you were God, was cover December 30th and long max on, so I think a lot of people are worried there just could be like a bit of a nasty rotation early next year, and they're just sort of hoping that it lasts. And then I start thinking, well, if I'm aspirationally average PM, and I think that now, maybe it happens 2 or 3 weeks before. And I just, I'm just trying to. It's all game theory at this point, but I am a little worried.
So you might revise this idea when you see the Goldman Sachs and the Morgan Stanley.
If they're all bullish,
2025.
I don't see how I can justify being bullish for the first half of next year, or at least I will be. If there's a 20 variable problem, I'll weight that sentiment variable more heavily.
Yeah.
Because that wisdom of the crowds has been like wrong. The worst thing, the best thing, what's the best thing? You're a contrarian bull and you're right. And that's like nirvana.
That's that's like that's the Belsky moment.
That's the best.
You're the only bull.
That's the best. Contrarian bull and you're right. The worst is, obviously you're out of consensus bear and you're wrong.
So what he just said is if Morgan Stanley and Goldman Sachs put out their 2025 year-end targets and they're bullish, then it's going to be really hard for himself to be bullish as well. Because at that point, pretty much all the bears have thrown in the towel and we're all consensus bullish at that point. Well, I'll be damned with what just came out today. Here's the headline. Morgan Stanley finally turns bullish on U.S. stocks as it says the S&P 500 could jump as high as 7,400. The Wall Street firm expects the recent broadening in earnings growth to continue in 2025. This article says perhaps better late than never. Morgan Stanley has jumped on board the U.S. train, moving its rating on U.S. stocks to overweight and targeting 6,500 at the end of 2025, compared to June of 2025's target of 5,400. In fact, its new base target is above its previous bull scenario, which was 6,350. Now it says the S&P 500 could jump as high as 7,400 next year. That is the bull case scenario. That would be a 24% rise in the S&P 500, with a base case scenario implying almost a 10% rise and a bear case scenario implying a 23% fall to 4,600. This article goes on to say why the change of heart. Well, the firm still says valuations are richer than they used to be. Quote, valuations should be richer than 6 months ago because markets have grown more certain that fundamentals are good, and valuations can be richer in 6 months' time when investors see that fundamentals are sustaining by solid macro, the firm said in its 2025 outlook. U.S. exceptionalism will continue, the firm argued. The multiple on 12-month forward earnings will contract slightly to 21.5 from 22.2, but remain at a premium to the 10-year average. Quote, our work shows that it's rare to see significant multiple compression in periods of above average earnings growth and accommodative monetary policy. They expect 13% earnings per share growth next year and another 12% in 2026. They say, quote, we expect the recent broadening in earnings growth to continue in 2025 as the Fed cuts rates into next year and business cycle indicators continue to improve. A potential rise in corporate animal spirits post the election, as we saw following the 2016 election, could catalyze a more balanced earnings profile across the market in 2025, according to the U.S. team led by Mike Wilson. It was also interesting to read the firm's take on the Department of Government Efficiency and its leaders, Elon Musk and Vivek Ramaswamy. They say, quote, while many are skeptical they will be able to actually cut spending via efficiency efforts, we think it makes sense to take a more open-minded approach given the individuals involved and the fact that this seems to be a focal point for Trump in his second term. They said, with the jury being very much out on the ultimate outcome, we think term premium will tell the story of how the bond market is thinking about this issue, referring to the excess return investors require for taking on interest rate risk. Morgan Stanley is also bullish towards Japanese equities. So yeah, long story short, one of the biggest bears on Wall Street is now bullish, and not just a little bullish, but very bullish. And it's kind of one of those situations where, if you guys have been in Wall Street for a while, you understand this. The market tries to screw as many people as possible. The consensus view is usually not correct. Think about this in terms of options, perhaps. If you win big on an option, someone loses big on an option. Well, if everyone is betting that, say, Nvidia will go up after earnings, for an example, if there's like a 95% of options to the bull side and 5% to the bear side, even if things are great, the stock can only go up so much. Those 95% of bull options, let's call it, can only go up so much, because who's paying out the rise for the 95%? It's going to be the 5% that we're shorting against that. It's going to be the, 5% of people on the losing side of that trade. So you can only make so much. Whereas if everyone's, bullish for that matter, 95% of options are bullish and the stock craters, well, you're essentially having 95% of the options paying out to 5% of the winners. That's where you can get these large returns if you are a contrarian in certain situations. Well, same is true for the markets. If everyone is bullish, there's not too much to, fuel that upside, right? Because there's not many people on the other side of that trade. And that's why when everyone is so skewed towards one direction, usually that outcome does not happen. Or if it does happen, it doesn't happen as much as people think, because you can only win so much if everyone is winning. And that's really the big catalyst for this week. It's Nvidia earnings. Now, there was news over this weekend that Nvidia's Blackwell chips are overheating, and this has many of the prospective buyers of these Blackwell chips concerned that they're just going to get these chips and not be able to use them for an extended period in time, or maybe the design changes and they're unable to use them entirely. Well, Michael Dell, Dell's CEO, he says they've already started to take delivery of these Blackwell chips. That is alleviating some of the concern that investors have today about these Blackwell chips. You can see here the first server racks with Nvidia's new Blackwell AI chips are now shipping, according to Michael Dell. Specifically, Nvidia earnings, I think there's a lot of uncertainty here. And let me explain why. We've talked about this in previous videos, so I won't stick on it for too long. But there's uncertainty about what margins are going to look like because of pricing. Think about it like this. If there's so much demand for Nvidia and it takes a long time to get these Nvidia chips, AMD and other competitors are starting to create chips that are more comparable. Okay, they're not as good as Nvidia, but they're more comparable. And they're selling between $10,000 and $15,000. They're a lot cheaper, albeit, than Nvidia's chips. And presumably you can take delivery of these AMD chips a lot sooner than Nvidia ones. Okay, so what does that mean for pricing of Nvidia chips as other competition starts to come in? Presumably, pricing is going to fall. These H100s, H200s, Blackwells, they're not supposed to sell for $30,000 to $50,000 a chip. They're MSRP between $8,000 and $15,000. They're overinflated because of all of the demand. That's why Nvidia has had the margins that they have had. So that could bring on some margin pressure. I think that is an uncertainty around Nvidia earnings, and I think guidance will be important for that. Margin guidance as well as top line revenue guidance as well. Does Nvidia see pricing being compressed over the next year. Now, if Nvidia does not provide 2025 guidance, as most other companies are right now, that would be an issue in and of itself. So that's something I'm personally going to be watching for. Also have the simple problem of Nvidia's growth rate slowing down. And that's what Wall Street really likes to see, is a growth rate that's accelerating. And Nvidia is just getting to the law of large numbers here, where their year-over-year comparisons get a lot more difficult because, I mean, in the year-ago quarter, they started doing really well, right? So it's a good problem to have, but it's still a problem nonetheless for a stock. It makes owning the stock a little bit harder if, let's say, you've been growing at 100% year over year, and now you're only going to be growing at 50% or so, or 25%, right? The growth rate is going to slow down. And typically, even with good companies, great companies, the best companies, as Trump would say, you do see when the growth rate slows down, the appetite for owning that stock also slows down. Mix in there what could be some pricing pressures, and you could have a negative cocktail brewing for Nvidia. Top that off with everyone being long Nvidia, everyone being bullish on Nvidia, and you have a maybe not so positive setup for Nvidia earnings. Now, over the past week, as far as hedge fund and institutional option activity, you have seen 2,795 different trades totaling $2.11 billion with a positive order value of 81%. Now, I'm sure retail perhaps is roughly as positive as this. So you have about a 5-to-1 ratio of calls versus puts, or bullish activity versus bearish activity. So you're set up in an unfavorable way heading into Nvidia earnings. What's actually interesting is the options market sees more risk for the S&P 500 from Nvidia earnings than from the next jobs report, CPI, or Fed meeting. Nvidia remains the most dominant stock in the markets, driving 20% of the S&P 500's return over the past year, and is expected to drive nearly 25% of the large cap index's EPS growth in the third quarter. A Bank of America strategist led by Equity Link analyst Gonzo Asis said in a Monday client note. He says, quote, "With the market taking a breather last week following the election rally, we believe Nvidia earnings can dictate the near-term direction of the market." They say, given single stock fragility on the rise and easing post-election euphoria, the Bank of America strategist said it is, quote, "sensible to hedge the potential added impact on the broader market in case Nvidia disappoints." Now, is Nvidia really going to disappoint? Probably not. They're going to beat on the top. They're going to beat on the bottom line. They're probably going to beat on margin as well. But that doesn't matter. It's all about what is next. And that, I think, could be somewhat problematic just on the terms of the growth rate slowing down, which is going to happen. So I'm also under that same assumption of Bank of America. I think a hedge here could make some sense given the extreme amount of volatility that we're going to see if the markets are disappointed. And now that you have even some of the biggest bears in the past couple of years throwing in the towel that are now bullish, I think it really adds to that risk here that now everyone is in the same boat, and it could be ripe for a bit of a reversal. Now, I do want to go back to the earnings calendar here, brought to us by Earnings Whispers on X. Tomorrow morning, we have Walmart and Lowe's earnings. Consumer stocks are big this week, in focus in this earnings season. Even on Wednesday, you have Target and TJX. Now, Walmart is specifically important because, let me take you back in a little bit of history. In 2007, the March through August quarters, both of those quarters, Q1, Q2, Walmart started to warn about a consumer that was slowing down, that was pretty rapidly slowing down. Wall Street shrugged it off for a while. Now, in that August quarter, Wall Street took notice. Market sold off 3% after Walmart's warning about the consumer and about a potential upcoming recession. And then what happened? The Fed cut rates 50 basis points September 18th. Markets rallied 3 weeks after that And then the dookie hit the fan, okay? That's when Wall Street started to say, oh crap, maybe things are not that great out there. And it did take some time. But the first real warning we had of this was from Walmart, and rightfully so. Walmart is the economic barometer. I think Walmart earnings, just put it this way, are more impactful, more accurate than economic data that we get, than any economic data set. No matter if it's surveys, no matter if it's hard data from the government. I mean, the BLS jobs report, like 30% of businesses report their actual hiring and firing. The rest is like a poll, like an election poll that they were all wrong. It takes a couple hundred businesses, couple thousand businesses, whatever the number is month by month, and extrapolate that for the rest of the economy. That's how the data works. Is that very accurate? Probably not. Now, Walmart's going to give us a much better indication of just how good or bad things are. Now, Walmart has said things are great for a while now. Do they change that sentiment? That's the question. Other question is, does Wall Street pay attention to this the way that I am paying attention to this? Now, the bottom line here, if Walmart has good things to say about the consumer, you should be more bullish on the economy. That's not financial advice. That's just my opinion. That's how I'm looking at this situation. If Walmart is negative on the consumer or starts to kind of change their stance, then that is absolutely something you want to pay attention to. That is absolutely a warning sign for the economy. And at that point, I'll keep you guys in the know. You know, whatever happens tomorrow morning with Walmart, I will cover it. I listen to the earnings call. I listen to everything that has to do with Walmart. It's that important. If there's any changes, I'll let you know. But I think this is a critical quarter as we head into 2025 and get even guidance, presumably, for 2025 from Walmart. Now, Target, TJX, they're not as important. Target kind of has its own demographic. Things are a little more expensive, right? Target's a little bit different. TJX is basically takes the products that Target, Walmart, other retailers don't sell. They get them for a discounted price. They sell those there, right? So that's kind of more lower income consumers, kind of like Walmart as well. But I think Walmart is the holy grail of consumer names for this week, and it just happens to be tomorrow morning. Now, here on the day today, the percent of stocks currently trading above their 50-day moving average has really just been ping-ponging back and forth in recent months, anywhere from 45% or so on the low side to 73% on the high side. Today, you're at 55.5%, which is kind of on the lower end side, but it's still in the range of where we have been over the past couple of months. You're actually up today. So 1.71% of stocks are breaking above their 50-day moving average today. This is 100, 200 plus stocks that are breaking above their 50-day moving average. That's a good sign. It's not a great sign, but it's a good sign that indexes are moving higher today. Some stocks are also moving higher. Now, CNN's Fear and Greed Index is interesting. You're sitting at 50 today, which is the exact same as yesterday. You have fallen a lot recently. 1 month ago, you were in greed territory at 74. Now you're only at 50, which is exactly in the middle of neutral. Market momentum is greed, and this is the S&P 500 and its 125-day moving average. Stock price strength is in extreme fear. This is the net new 52-week highs and lows on the New York Stock Exchange. So in other words, you're not seeing a lot of stocks breaking out to a new 52-week high. This is not happening right now. Stock price strength, extreme fear. Put and call options is neutral. Market volatility is neutral. Safe haven demand is greed, and junk bond demand in extreme greed. Now, something I've talked about over the past maybe week or so here almost every single day now is the VIX. Now, the VIX today is even down about 3.5%. That means there's less fear in the markets today than there was on Friday, which makes sense because you do have some stocks going higher. But you're not pricing in that much fear, uncertainty, doubt, FUD, just fear, right? You're not pricing in much in terms of downside or hedging, because the VIX works off the S&P 500. One call skew to put skew. Are calls more expensive than puts? Are people buying more calls than puts? If people are buying more calls than puts, if calls are more expensive than puts, then the VIX goes down, right? When puts start to gain more traction, the VIX goes up. So basically, the more fear there is, the more the VIX goes up. The less fear there is, the more the VIX goes down. The VIX has completely collapsed since the election, which was expected. The VIX hit a high of 23, which was abnormally high heading into the election. And that's one reason why I was bullish on a post-election rally. But it's fallen way too much, down to more complacent levels. Okay, when we are in a higher risk environment, you're back to some of the levels you were at in 2024 during some of the peaks, like in February and in March. Even back here in April when we had a 10% correction, the VIX got to about 19. You're at 15.63 in a high risk environment. When we have Nvidia earnings coming up, a new administration with potentially good and bad economic policies, it doesn't seem like we're actively looking at the potential bad policies. There's so much uncertainty right now. You're not pricing that in, or at least investors are not pricing that in. And I think there should be a higher VIX than where we are today. I think the VIX should have come down probably to that 18, 19 range. It shouldn't have been at 23. So you should have seen a rally. But we're growing a little too complacent here. With everything is fine, everything is dandy. When, even if that is the case, there's too much risk to assume that at this point. And the markets are assuming that everything is going to be okay. Now, keep in mind, I'm actually pretty bullish on what's going to happen in 2025. I think there's a chance of a recession. I don't think that is a certainty at this point, and Walmart will provide us more clarity coming tomorrow morning. But I also acknowledge the risk that everyone's bullish, that consensus is bullish. Literally everyone's in that boat, even Morgan Stanley and Mike Wilson now, which is kind of a contrarian indicator in and of itself. Like, I acknowledge the potential problems that we don't know if we're going to have a soft landing or not. Wall Street has not realized that just yet. Now, with Nvidia earnings, that's obviously going to be the biggest catalyst, and there is problems now with Nvidia from a more structural standpoint. So we'll see ultimately what happens, but I don't think we're set up in a good risk to reward scenario for the bulls. So let me know what you guys think about this information down below in the comment section. There will be more to come on this, especially as analysts start to give their takes on Nvidia earnings. That's really is going to be what dominates the markets today and after hours, tomorrow, even Wednesday. It's all going to be about Nvidia. And I would love your thoughts on that down below in the comment section. A lot of people are starting to talk about Nvidia potentially testing that 50-day moving average before we get to earnings, which is going to be around $132 per share, which would represent about $7.50 of downside here. And if we were at the 132 level, perhaps we'd be in a better position from a risk to reward perspective for Nvidia. But hey, what do I know? Let me know what you think down below in the comment section. Have a great rest of your day, and I will see you in the next one.